And let's get started. Hey guys, this is another show of the SIH Capital monthly webinar series where we bring on one person just to talk about one specific topic. We focus on quality, not quantity. So we're not trying to do a webinar or podcast every single day. We really are just focused on bringing some great talkers out here. I had the fortune to come on Pablo's show. That's how I met him. I knew Pablo was different the first time I interacted with him. So when he offered to get me on a podcast, he booked me. I booked an appointment, and I thought it was the actual podcast. And then we get on the pre-call, and we spent like an hour just talking. And he obviously wanted to see if I was a good fit. Usually 9 out of 10 times, I'm not a fan of that approach because sometimes I go to it where I'm like, oh, okay, let's just get the podcast over with. But Pablo, he took it so serious. He had such a well-defined plan and really talked it out where I really saw the benefit of that introduction call versus sometimes I get in and they're like, oh, okay, so you do know what you're talking about. Let me schedule you. With Pablo, we really went over how to make that show great. I remember that episode started and Pablo was like straight out of Ace Ventura, just pumped full of energy. And it was just like, all right, this podcast is going to be it wasn't even a podcast, right? It was a webinar, right? So this webinar I felt was going to be different. It was a great hour. We talked a lot about how turnkeys interact and kind of like a comparison point with the stuff that we do at SIH Capital Group, which is we help investors invest passively, and we take that money and we buy apartment buildings and we get into bigger, larger scale deals. So it's a very different asset class, but truthfully, a lot of people come to me and they ask me like, hey, what do you think about turnkeys? Because I'm known in the industry a little bit for multiple alternative investments. It's not just commercial real estate. I wrote a book about commercial real estate, ATM funds, mobile home parks, self-storages. So I would get a random question all the time. What do you guys think about turnkeys? And tell you the truth, since I don't have an operator in my circle that I fully trust and that I've invested with, I usually say nothing. But when I had a chance to talk to Greg and the JWB team, I saw a lot of their pros and cons. So I would love to, when people do reach out to me, hey, who do you know in Turnkey? I'm just going to say, hey, go to JWB, go with Pablo and Greg, they're great guys, and they know what they're doing in Turnkey. So after our webinar, I asked Pablo, hey, do you want to come on mine? I'll get you in later on. And he's like, yeah, absolutely. What do you want to talk about? And we kind of talked about this concept of turnkey vetting the operator, because in passive world, doing the vetting on the operator is probably the most important part of your investment. If you got there's a really famous slogan in the syndication space. It's if you have a good operator, he could salvage a bad deal, but a bad operator will destroy a great deal. So that is the truest, that's one of the, slogans that I absolutely live by. So when Pablo talked about, hey, let's do this turnkey, and a lot of it's going to be on vetting, and turnkey does have some black marks when it comes to, certain turnkey operators that did not do right by their investors. So I was like, wow, this is great. Yeah, let's get this on, because this asset class, a lot of people talk about, and it's something that I think people are going to want to know more about. So that being said, Pablo, I'll hand it over to you to give a quick introduction, and then we'll just have a conversation about turnkeys. I would also love to circle back on something we were just talking about before on the importance of networking. I am huge on networking, and you gave that timeline of 2 years in your in our pre-recording conversation, and it's so true. That's exactly what it took. 2 years for me of heavy networking, where I was like, wow, this is amazing. I have an amazing network built up. It's almost like overnight, but it took 2 years of overnight to get there. So Pablo, hand it off to you. Let's get this conversation going.
Dude, let's get it on, like you just said. And for the record, Dennis, the fact that you compared me to Ace Ventura is one of the greatest compliments that you could possibly give me. I'm a huge fan of that movie, man. I really appreciate being here, Dennis. I felt the same way when I connected with you. I saw a very emotionally intelligent guy that values relationships and the long-term, compounding asset that is. And I think that that's really where we connect. And then I read your book, and it's awesome. And it's a really well put together formula for content and education that I really, really admired, man. And then we had you on our show, and it was great. I am, Dennis, what I guess I would classify myself as like the noble fool of real estate investing, in the sense that I got and I don't know if you're not familiar with the archetype of the noble fool, it's across every culture, right? Like the kid in the emperor wears no clothes is the noble fool, right? Like there's a famous Russian one, and every culture has one, but it's the person that gets put into a situation, and because they are just novice enough and they get just enough leeway to maybe act something that everybody else would think they'd make look stupid, they get to do it, and as a result, people get to benefit. So JWB is, full disclosure, they're my client and they're my favorite client. And Greg, the guy that I host that show with, has become my best friend and one of the biggest influences in my life. But for them, I'm just a marketing content strategist that had the good fortune to find a company that really cared about long-term relationships, and they've been doing it in their own little silo of the world for 12 years. And when they were thinking about how can I make great marketing content, I was like, dude, what you need to do is shine a spotlight in the people that you do business with and the people around you that are doing great business. And as a result, everybody's going to find their own slot. And what you see now is there's, out of the people in this webinar, 1, 2, 3, 4 people have come from that community of that show that we created, because we've been able to just bring together like-minded, smart investors that see the value in this like long-term relationship building thing. And that's really worked. But the reason why it worked is because they operate like you operate, man. Like, right. Like adding value, networking, doing things right. And I've gotten to basically tell their story while learning what they do is all what they do is all about. And as a result, and then surround myself by a bunch of people that have been doing that with them. And it's like if you made me a character in like the Rich Dad Poor Dad miniseries or something like that, right? Like I've just gained all this wealth of experience from people, which is the way that I learn. And as a business nerd, I've gotten to watch how they operate and model my business around, like the principles that they've built it. And I'm all in, dude. Right. Like I was just telling you, I've bought 3 rental properties from them in the last year and a half. And I just cashed out like an IRA that I had, because I have these beliefs of, I think the stock market is about to slide somewhere between 30 to 40%. And if I take a 10% haircut to lock in a 18 to 20% return over the next 30 years, I'm totally comfortable with that. And I'm here to just be very transparent in how I've evaluated this as an outsider looking in, so that maybe it clicks for somebody that maybe they've looked at it and they haven't been able to be like, I don't get the value of this right now. I'm still new enough to the game that I think I can explain it in a novice's curious mind and make sense, I guess. So that's hoping that's the value I bring. And yes, I think more about how to make friends than anybody thinks about it. So if we get into the networking piece, I'm sure I'm going to drop some good stuff that people can use if that's what they want to do, man.
That actually reminds me. When I was writing my book, I always ask the question, like, what is the one biggest piece of advice you would give? And some of it was generic, but one of them actually said something pretty amazing. And I think it reminds me something about what you just said, that you have 3 properties, you have a novice, and you have a good personality, you're trying to learn this stuff and you're willing to share. So one of the things that I remember from this book, and I think I'll remember for the rest of my life, is it also goes into networking, is when you're starting out networking, you do not want to go out and network. Like if you want to get into turnkey rentals, don't go out and find the person who's done 100 turnkey rentals, because you're not going to have a similar enough language to them. You want to go out there initially and find the person who's done 1, 2, and then 1, 2, 3. And you want to be able to talk to them because they have recent experience. The guy who's done 100 is not going to remember that first deal at this point. But the guy who's done 3 will really remember that first deal and a second deal. And then it becomes, it almost becomes a moot point, because it's not really the deal. It's the opportunity that's presented because of your network, and your network presents you with opportunities. So the better your network is, the better those opportunities that you're going to get.
Well said, dude. Well said. I see networking and relationship building equivalent to diversification of my time and my greatest asset, which is, my time, right? Like, so I very, very much believe in networking the way that I think of an investment. And I approach it in a very systematic fashion. And what you said is 100% accurate, right? Like the novice's perspective often has a lot of value. As a guy with a very wide, breadth of relationships across different things, I know that the majority of my values that I can be like, oh, okay, I'm learning this for the first time, but it's not unlike this other thing that I heard across a different context. And if it's working in this context, there's something else that works in this context that may also work in this one, right? So I think that idea of the novice's mind and the curious mind as an underrated asset to understanding and finding opportunities, I think is very, very real. So yeah, thanks for validating that, man.
So Pablo, let's rewind a little bit. So you said you bought 3 properties in how many months? So you say 18 months?
Yeah. 3 properties in 18 months. I closed on my first one in January of 2021.
21. All right. So let's rewind there. How long did you know? This was from JWB Properties, right?
All JWB.
JWB. Okay. How long were you doing their market? How long did you have that relationship for before you bought the first piece of property from them?
I was doing the marketing for a year. But prior to that, right? Like in 2014, when I was in Miami, they also have a private lending program. And one of my best friends from college is, really good friends with Greg's business partner. So when like 2013, 2014, he just, we got a WhatsApp chat of all our boys. And he's just like, yo, man, I've been putting down this money, 10%, and just keeps rolling over and it's sweet. And I'm like, bet, let's go. Right. So I placed 50 grand with them in a private lending program. They paid me out ahead of time. And in my head, I was a very unsophisticated investor. I was just like, this is short term. I'm going to cash out. There's an election coming up. I don't know what's going to happen with this. I didn't understand the financial vehicle behind it. Right. So I pulled my money out, and I still to this day, I wish I would have kept that in. So when I got to work with these guys, I was just like, hey man, I want to be the reason why people don't make the same mistake I made, right? Like, I think people putting money with you guys should really understand what they're doing. So I had a bit of a relationship back then, even though I didn't really know them. Then, by December 2019, I started really talking up. Full disclosure, right? Like August 2019, they invited me to their like charity volleyball tournament. I was on a team with Greg, and he's like, I'm doing content strategy. I'm like, oh man, I got this client that's a content strategist. I was trying to give him advice. Then I was at their golf tournament in November, and I'm like, how's that content thing going for you? He's like, it's a kick in the teeth, man. I need some help. So we got together for like a happy hour in December. I, dream wove this like idea of this like community-led content experience. He bought into it, and it was like first week of January 2020 that I was in there doing the marketing thing, right? Asking them who their ideal client is, asking what their value prop is, and really starting to understand the business. And it took me about a year of doing that and running the show with them and running strategy for them while, I was actively trying to build a relationship with him. So I still to this day run at 5:15 in the morning on Tuesdays and Thursdays. I go on like a 4-mile run with Greg. So like it was a lot of those. It wasn't just the show. It was a lot of those runs. It was a lot of the in-between things of me really understanding stuff, asking him things like, yo, man, I'm renting in Jacksonville, but does it even make sense to invest in a rental property before I buy my primary residence? Like just really poking holes at everything. And in the meantime, asking all my smartest friends, like, why aren't you guys investing in this? And understanding why they weren't doing it, until it really just started making sense with me once we started analyzing a property every single week, which we call the property of the week, right? Like we do this like Thursday property of the week thing. And started really diving into the concept of leverage, and then it started really making Marilyn, this is week, right? Because we do the echo. And then that piece started really making sense to me, along with the experience of when they were recruiting me to see if they wanted me to be their marketing strategist. It's like, hey man, we expect everybody to come to this like all hands meeting that we have on Tuesday mornings. It's called the TMM, the Tuesday morning meeting. And I'm like, yeah, great. I can't wait to go to some other company's all hands meeting. Awesome. And I showed up, man. And immediately it struck me that this is a different place, right? Like it was at the time, 85 people completely locked in on each other. They started off with these like core values call outs where everybody on the team gets to stand up and compliment somebody else that they've seen living one of the core values and talking about the core values. And then they go into like each department talking about their, like, it just and I looked across the room and I'm like, this is like a Harvard Business Review case study of like every demographic in leadership positions and people communicating. And at that point, I'm like, okay, so this is a different kind of business. And then the assets started making sense to me. But by end of the year, I was like, just take my money, bro.
So, but what's interesting here is that you were leveraging what you're good at, and he saw that, and because of that, you guys created a relationship. And during that time period, you kind of got a behind the scenes look into that asset class, which is unique because a lot of people, the way they learn asset classes is they'll go and they'll get on a podcast and stuff like that. And there's nothing wrong with that approach, but you're not going to get behind the scenes approach. But so that's that's amazing that you were able to do that. But B, if someone didn't have that access, right? And now you bought 3 properties and now you're talking to them and they're interested in turnkey. And we could do some comparisons a little bit about turnkeys versus syndications, and we could talk a little bit about pros and cons. But let's give that scenario of someone who is looking into maybe, they have, let's say $100,000. They're worried about the market and they want some kind of control. So they think that, it's a good hybrid of control and passivity because there's an operator in between and they want to get started. And let's say it's not JDB, it's a different operator. Like what are like the top 3 things that you've learned in this process that the people who've had bad experiences with turnkeys, they didn't do this?
Yeah. This is a great test for me, man. I appreciate this. So what I have learned is that turnkey rental property investing has 5 profit centers. And you got to be aware of the 5 profit centers. I'm gonna take your word for it. I'm gonna do 3 things, right? But the first one is 5 profit centers. So you got to understand how the 5 profit centers are different levers of what you're going to get out of the asset class, right? There's cash flow, there's tax benefits, there is debt pay down, there's appreciation, and then there's inflation hedging, which I honestly don't understand how to quantify, right? But I know that that's real. So because of that, you can either opt into a situation where it is cash flow rich, and or which allows you to do things with that cash, money in hand, present day, right? Or you can opt into situations that are, heavy on appreciation, right? And then the other 2, I don't really know how it varies market by market, but I understand that the markets that exist kind of have that give and take between cash flow and upside of appreciation, right? So when you're taking that stuff into account, there is a handful of cash flow positive markets in the United States, right? Where the property value and the rent price are, and the market is going to make it so that you are cash flow positive every single month. And that to me, I have grown to understand that it's like the entry point to that is really heavy risk mitigation in the sense that if I wanted to invest in Miami in a negative cash flow market that I thought was going to just boom, right? Or let's call it New York or San Francisco, where I know that property is going to appreciate. If I wanted to, I could buy a property, charge less rent than what it's worth, than what my mortgage is. And eventually I'm going to make money on that appreciation and those other profit centers. But every month I'm going to be coming out of pocket a little bit to give up for that, right? So if that goes too south, that's a heavy risk thing. And it's also going to impede me on scaling that investment out, right? So I have grown to understand for myself that I want a cash flow positive market because it's I describe it kind of like arm strength in the NFL, right? You want a quarterback that can make every single throw, but at a certain moment, Joe Flacco, who had a canyon, was not better than Tom Brady, right? So there's other things that matter more when it comes to winning games. And in rental property investing, that lever of cash flow to appreciation is usually a little bit juxtaposed. And in the cash flow markets, Jacksonville is one of the ones that has one of the lower cash flows, but it has the highest historical rate of appreciation, right? So and when you end up looking at how much money you make off an asset, if you are considering it a buy and hold asset, something that I'm going to not touch for 25, 30 years, then you can count on historical rates of appreciation to be pretty safe, right? So Jacksonville's got this 4.6% appreciation rate. And other markets that have heavier cash flow, like Birmingham or Cleveland, they're like a 1% or something like that, right? So it still appreciates, is not as much. And if you look in the long run, that the buckets, like when it comes to like returns, if you look at a pie chart, it's like cash flow, tax savings, debt pay down is pretty constant because all you can make is back the debt. And then appreciation can be a super high lever if you take it out in time and look at your ROI, right? So that's the first thing to understand, is that those 5 profit centers exist, and that biggest upside that you have in the long run is appreciation, and the biggest upside you have in the short run is cash flow, I guess, right? So that's one thing. Then I realized what you said, that it's the team, right? Like the operator can make or break that deal. The operator is really what controls that hedge point of risk. And, your short-term cash flow is going to greatly depend on, like, it's going to appreciate however the market's going to do in real estate. But that short-term cash flow stuff of like staying positive month over month is going to greatly depend on the ability for that operator to keep that place rented and to minimize turns. Because the biggest kind of like hit to you is the turn, right? Like you can predict all the other expenses of like your roof is going to go in this amount of time, your mechanicals have this much shelf life, but minimizing turns inside of your residence, that's the way that you can really over deliver on the asset and on that cash flow piece. Because every time somebody leaves, you're gonna be in for at least like a month and a half of like mortgage, plus like painting the house, doing the carpets, whatever, right? So understanding that piece, that like you really, really need to find a good team that you trust, is great. Thanks, Zach Correa. Dude, Zach in the chat is a guy that you totally have to connect with, man. He's got like everything from a rental portfolio to like alpaca, like he's won like best in class in alpaca farming to one like rookie of the year in the California horse racing scene. Like he's just the most interesting man in the world. Anyways, I digress. So that's the next piece, right? And then I found that when vetting an operator, what you are talking about, the more that the operator is incentivized long-term by what you are doing, the better that they're going to act for you. And that part was very natural for me, right? Like the idea that I graduated an economics major, I really believe that whatever you're incentivized by is how you're going to act, right? People are going to act in their best interests most of the time. And so understanding that the operator that you're at has the knowledge of the market, has the operational capacity, is a great communicator, great customer service, and that there is some way where they win when you win, right? So that's kind of the stuff that I've grown to understand. And then because of that, if you're doing a good investment, right? Like if you are investing in a cash flow positive market and you are using debt to finance the asset, and you can be there for a long time, right? I see this as my like 401k, my set it and forget it long-term asset class. Then it is mathematical that if I put down 20% on a property and I'm gaining from the appreciation from 100% of the property, then I can count on the historical appreciation rate times 5 as the baseline return long-term. Or if I'm putting down 25%, I can count as the historical appreciation rate times 4 as baseline return. So that's why when I was speaking earlier, like this idea of locking in a 16% return to me is I financed them for 25% down. I'm going to hold on to these things. I'm 41. I'm going to hold on to these things at least till I'm like 65, right? So I'm baking in that 16% return ROI over time, which when I look at the historical average of the stock market, it's like 8-9% if I'm doing great, right? So that's the 1,000-foot view. I feel like I just talked for like an hour, and give me feedback. Tell me what you think.
So I'll throw out something interesting, because you were talking about the different levers, and the main two are obviously cash flow and appreciation. And a lot of people don't know this. I'll relate this a little bit to the syndication space. Is when a lot of investors reach out to me to look at a different operator's deals, and I'm very careful what I say. I try not to be negative or anything like that. But what's really interesting is what I notice between the experienced and the inexperienced investors is the experienced investors would look at the pro forma and they will actually see how much money is coming from the cash flow and then how much money is coming from the back end of the sale. So at first it's like, oh, it's great, it's a 20% return. Yeah, but the cash flow is only going to give you 4, and then they're expecting, you're going to average out that 16 on the back end. That's actually riskier than a deal that actually has that 7% cash flow and then a steady 7 the 5 years of the life of the deal. And then at year 5, you're going to sell it for an additional 7 because you just need less appreciation to happen at that point. So that's definitely interesting looking at it from that perspective, because it kind of just simplifies it. It's like, hey, if you're just completely banking on, getting a San Francisco appreciation type, what happens in the last 2 years when San Francisco is no longer appreciating and going the other way? Now you lose that safety. And the cool thing is, what I'm hearing from you is that you really are not going for home runs here.
No.
Like, even though 16% is an incredibly good return if you consistently average that, but what it sounds like is you're just going for singles and just doing, is your plan to do like 1 a year, 2 a year? What are your plans in regards to that?
Yeah, man. That's very perceptive of you. I see this as, I think the first investing book I read, I didn't even know it was an investing book, but I read the book Black Swan by Nassim Taleb. And I really do believe in this like world of rapid change all the time. I do believe in this idea of investing like 80-85% of your stuff into as like stable thing as you can long term, while taking some really high upside bets on like 15 to 20, like 15 to 10% of that portfolio, right? Or like that exposes you to positive black swans. So I see this bucket of my investing as the, I probably want to be at like 50% of my total portfolio. Right now, I'm totally over leveraged in it because of what I think is going to happen in the stock market. But I want to get to the point where like 50% of my net worth is tied in something that I know is set it and forget it and is going to give me the best yield I can. Right. So I'm not trying to hit home runs with these. Right. If I hit a single or a double, I'm pumped. I've also seen my dad, who has a high net worth and is almost exclusively in the stock market. He's now in retirement. And right now he's in retirement and he's living and dying by this, like, the amount of cash flow that's coming in and like wondering if he's going to go, like be 2 months in Spain or like a month or whatever. Right. He's still going to be all right. But he's very cognizant of this happening. And I think that by the time that I am 65, 70, I much rather be thinking, am I making rent income? Like that like steady cash flow that comes in from rent when this stuff is paid down and I've like refinanced it or whatever, right? Like that cash flow at that period in my life seems very, very attractive to me, much more so than the idea of like, well, I'm going to try to put 5 million away in the stock market by the time that I'm 65. And then I'm going to just like live off of like my Merrill Lynch guy, what he says he can break me off that month. You know what I mean? So that's where it sits psychologically in my head. Is that the question that you asked? I think that was one part of it.
Yeah, no, I think that's good. That's definitely good.
Yeah. And to what you're saying, like, I think, so I'm not an accredited investor yet, right? So like syndications to me are still somewhat foreign, but the way I understand syndications, it's a shorter timeline, right? So like you definitely need to hedge that thing with more cash flow on the front end because of that shorter timeline. I definitely understand that I'm only banking on this idea of 4.6% appreciation if I'm thinking about it in like a 20 plus year cycle, and it's really going to like even out to an average, right? Even if it's been like 15% in Jacksonville for the last year, I'm not counting on that. I'm fully counting on the idea that there's going to be like years of 1% or even less, that it's going to even it out to like 4.6% appreciation. But for me, I'm trying to hit that. I'm trying to hit that cash flow goal when I'm like old and I don't want to be hustling,
No, definitely. And yeah, most commercial real estate, usually the mortgages are so they're amortized for your usual, 25 years, 30 years. Even you could get certain HUD products for 35, but the actual term is still 5 to 10 years unless you do go HUD. Yeah. So that's why you do have a shorter timeline. So that's why it's a little bit more of like a business plan, and it's not a long-term hold, but definitely more of a medium hold, I would say. And the last 3 years have been nothing but short-term holds. Like if you got into a syndication anytime in 2018, 2019, you cashed out and you doubled your money, but now what? Yeah, but then the question becomes, now what? Right?
Yeah.
Because I'm seeing the deal flow completely not stop, but really, slow up. And now you just got out of all these deals. You can't get into new deals right now, really, because you just got out of a certain cap rate. You're going to be going back in at a certain cap rate. It's like all the people who have all their equity in their primary home and they rush to sell.
Yeah.
And now they're trying to move and they're trying to buy another house in the same neighborhood. And they're shocked at what price it is. Yeah. It's like, why are you shocked? You just got paid for that house with that price. Yeah. Unless you're geographically dislocating, you shouldn't be shocked at that price. So no, it's definitely, I like the long term. But what I really like of what you said is that it's part of a portfolio. And like in my book, I had this pie chart and like I split it in the middle. And I'm probably heavier from alternative guy, the heavier of how much I keep in stocks, because I usually do 50% in stocks. But my other side of the pie has all these different slices. And then when you're looking at it from like a slice perspective, you tend not to panic. Like you tend to have just an even kilt mentality. Like I have an investment club, and one of my really good friends, and this is the first time I'm kind of seeing him panic. And he got into crypto, and where he's like the last couple of weeks that you could see the build of panic, right? So finally today, I'm like, hey, why are you panicking so much? Like, what is your exposure to this? And I'm expecting him to say 25, 30%. He's like 3.5%. I'm like, what? I'm like, why are you panicking? This is under 5% of your total net worth. Yeah. And you're freaking out. This is the time to be calm, collective, and say, hey, there's a reason why I had that original allocation. And I like the fact that you have this benchmark now. Hey, you know where you kind of want to be in 5 to 10 years. So that gives you a really clear path of whether or not you're going to buy 2 single-family rentals or start mixing it up with different type of investments. Yeah. But you have like a clear path because you have a goal to hit a certain amount. And as your network grows, then you're just going to add to that portfolio.
Yeah. Yeah. And listen, man, I'm also in a unique situation in the sense that I'm an entrepreneur. I started my business 2 years ago, right? Like I'm right now in the throes of like, is this thing, like this next like inflection point on my business is when I either start making significant income going forward, or I'm like, maybe I should just go get a job or be a solopreneur and go out and hustle on the side. You know what I'm saying? So for me, I was looking at stuff as like a bucket of money that I have, right? That isn't getting dollar cost averaged. And I know that my highest earning potential years are the next 15 years. So if I can park some money in this thing right now and then dollar cost average and the stuff that makes a lot of sense to dollar cost average, because it's got the smaller entry points, then I can over leverage right now and then just eke back in. And if I'm as smart as I think I am, then I'm also going to be getting back in at like a really good time to get back in.
Sounds good. So let's get into more, let's go back into the turnkeys a little bit. Yeah, so please. One negative that I always hear from potential investors about potentially investing in turnkeys is that the mortgages go in your name and you can only have a certain amount of mortgages. Mm-hmm. I'm curious, during those runs with Greg, for that year, I'm sure that question came up, and how much planning are you doing now so you don't get capped out in the future?
The way that I understand it is I'm a married man. I can have 10 mortgages for rental properties, and my wife can have 10 mortgages for rental properties, right? So The first 3 are all under her name because she's the W-2 person. And then later we're going to get to that, man. I would love to get to a portfolio of 20 homes, right? Like that would be great. And I don't really need that much later on, but my planning is that I can get to 20 homes based on just regular levers that I don't have to over engineer. And I also have grown to understand that once I'm at 20 homes, things open up. The other thing that I understand is that if you are with the right lending institutions and you are cash flow positive on every investment, it doesn't hurt your debt to income ratio because they see it as a revenue generator, right? So like, this isn't going to knock me on being able to get like a home mortgage when I want to buy a house here in Jacksonville, because these things are like little business units that are producing cash flow, and it's not looked that same way.
Interesting. So you already thought of it, and when you were applying for that first mortgage, basically you got walked through. It's like, hey, don't do this as a joint mortgage. Let's split it up. It'll give you a lot more flexibility in the long run.
Yeah, man. And that's, like that's one part my seat as not your average investor show host and whatever, but like, JWB's team is they're just very, very trained. Like you get this like service manager, right? Like your portfolio manager, right? So like it is a heavily educational sale. Like they don't let you like call them up and be like, yo man, I want this property. Like it's like 3 calls before they'll even show you a property once you're fully educated on like, does this make sense for you? Because they see this as a long-term investment. So again, the person that you're doing business with should be actively educating you on whatever you're doing if you're going to be getting into this. And they should be thinking of it as like, yo, man, I'm going to service you for 30 years. I want to make sure you're not a jerk, like, or that I'm not sticking you in something that's then going to create more work for me on the back end. So we were educated on that stuff on the way in.
And you mentioned that you originally went to 2 events that they hosted, right? Two charities. There was a golf and a volleyball outing in the start.
Yeah.
Did you meet other investors that were there?
No, man. So the first one was actually like a culture event that they had. And my buddy that I told you about from college that's friends with him, his wife does all their insurance. So she was like invited to this thing and she knows that I like to play beach volleyball and I was just starting my business and wanted to like introduce me to them again. And then the second time she was sponsoring a tent and she was like, yo, come be my hype man, right? Like come hang out at my tent and be like, cool.
I can see
like,
that.
Yeah, right? So I did that. Yeah, man. And at that place, yeah, there's a bunch of other investors, but I'll be honest, man, I just was not, I'm not before this experience, I would not have been the guy that like talks to investors and is like, all right, man, tell me about the deal and the numbers. Like I felt very insecure about the whole thing. And most of the investors I knew were flippers and wholesalers. And then, like my network in Miami, they're all like HIG capital guys. So I feel much more at that point in my life, I felt much more comfortable talking about investing in businesses than in real estate. So I met other investors, but I thought I did not get deep enough into it to understand the active versus passive nature and the real nuances of like not being a plumber if I want to go be a real estate investor,
Yeah, it's interesting that you mentioned that you didn't have that nuanced conversation because, 9 out of 10 of my, networking calls, it never gets to the nuance where you're pulling out a spreadsheet, right? It's more or less, it's like, hey, how's your family doing? Blah, blah, blah. And then you kind of get into briefly about a certain topic because at the end of the day, it's on you to do that due diligence, not on anybody else, but you're looking for certain keywords that they might say like, oh, you know what? That is actually pretty interesting. Or that's an asset class I should research or, vice versa, where you're like, oh, that's not for me, so it's interesting that you mentioned that.
Yeah, that's for sure, man. And the majority of people that I met were wholesalers and flippers, right? Like, and even in Miami, it was like flippers, right? So I didn't know very many buy and hold folks. And then I knew people that invest in syndications and I'm not an accredited investor. Right. So like, I never got into the conversation of like, no, dog, I'm a W-2 guy that's just like parking my 401k money there. Like that the idea of non-recourse loans and investing inside your IRA or 401k, like none of that stuff has ever been brought up to me until we started talking about it on the show.
Got it. Okay. So I want to do like 5 more minutes of us talking and then I want to open up to a Q&A and then I just want to end it at 8. So one thing that I think your biggest skill set, and I honestly, it's probably my biggest skill set is networking, right? Yeah. I live and die by network. And I actually tell other investors, especially in the syndication world, because if you're not willing to network with other people who are investing in those syndications, you should not be investing $50,000 into your deal because you're going to go in blind and you're going to be a victim to marketing. Right? At that point, networking is what gets you over the fact that you got attracted by a shiny presentation. Yeah. Networking is what allows you to actually dig in if you need to dig in with the numbers with someone. So I know how networking works in the passive space. That's my bread and butter. How does networking work in the turnkey space?
Man, I don't want to pretend like I know something I don't here, Dennis, man. Like I just know networking as a human being, right? Like for me, I'm lucky enough that as a skilled networker, I was able to build a community of passive investors. And that's been opening up a whole bunch of doors. So I don't really know how to answer that question, and I don't want to like misrepresent myself, you know?
So just in your network, right?
Yeah.
Do you have a lot of turnkey investors that you talk with, or it's
Uh,
more from the? Yeah.
yeah, man. All like the five of them are on this call right now. Like four of them are on this call, right? Like Zach and Marilyn and Drew, right? So Drew Barnhill, who's here right now, he is a turnkey investor that is like Mr. Data Research guy, and like every financial lever trick that you could possibly imagine, he has pulled it, right? So I was very happily gifted this like community of people that are all doing the passive investing networking. And now I find myself, yeah, Drew's saying he bought the last one on credit cards, dude. Like he's just like going card after card. Yeah, he's got a whole thing, right? He's a financial engineer wizard. But what I have found, man, that has been really, really the unlock is networking with people that have stages, right? So, and by this, I say that way before I was a podcaster, I started going to podcast conferences because I'm like, dude, if I can meet 100 podcasters the day that I need to like get in front of 1,000 people, I just got to talk to 10 of those dudes. And they,
Yeah.
like, a podcast with 100 listeners is like baseline, right? So I started doing that, and that was before I was even niching into the investment space. Now that I've had this experience of being in this investment space, going to Podfest Invest, I've also realized that content creators in the financial education space are the answer to everything, right? Because they, number one, are astute networkers to begin with. They have a stage and can put you on it, and or have had whoever you need to meet on that stage. And they got cash flow, right? Like they generally, anybody that's out there like you educating other people on how to make money has figured out how to make money already, right? So like there's a big difference between going to like the YouTuber conference and FinCon, right? The YouTuber conference can be like 16-year-old Molly who wants to make bubblegum videos. FinCon is a whole bunch of people talking about this around content, and they all have an opinion on it. They've practiced speaking about it. They can introduce you to other people, right? Like they are the super connectors in the space. So I don't really think of it as like the passive or active or whatever. I think of it as like, man, are you out there harvesting a community? Then I want to be in a room full of people that are creating a community, because for every one person I meet, it's the potential to meet, 500. And that's how I get leverage on that.
So I think just to kind of, from my take of that, is that there is no difference between networking and syndications and turnkey. It's good networking is actually getting to know other people, providing them value. And then if you have a deal that you think, hey, I need to do something creative, you reach out to Andrew, not because you want to use Andrew, but just because you know that's Andrew's cup of tea. Or, Zach, and hey, someone's offering me a purebred in Kentucky. Is this a good deal? I'm going to reach out to my guy, Zach. That's exactly the same way in passive investing, because I don't do a couple of things. I don't do turnkey. I don't do industrial, but that doesn't mean I don't know a guy there that I've had other conversations and I've got to know what their kids are, what their family goals are. I've got to know them in a micro grain kind of a way, where the moment you get an idea, you already know who to reach out to. Yeah. And that's what allows you to pull that trigger. That's what allows you not to have the analysis paralysis where you're not doing a deal because you just don't have that network with you. So I think that's just awesome.
Yeah. And my buddy Douglas Orr recently said this. Like he came with me to Podfest Invest, and he hadn't started a podcast, and he was like, you know what? I'm going to start one now. And all I needed was a little bit of cognitive bias, right? Like and what he means by that is like, see it to believe it. With anything that you're trying to do, it becomes so much more real if you see somebody out there executing it and living it, man. Right? Like this dude, I admire him so much because 9 years ago, he was a assembly worker in a Honda factory, and now he's got 120 doors under management. He bought a brokerage, like he's fucking killing it, right? But you know, everybody has that thing that they're a novice at, and the ultimate shortcut is coming up close and personal with somebody who has lived all the experience of what it takes to get to that next thing that you're a novice at, that you want to be an expert at, man. And that cognitive bias, I experienced it, right? Like when I was starting my business in 2019, I was trying to figure out what I wanted to do. I went to 4 conferences. I literally came home with like a spreadsheet of like 450 people that I met. That's how, like, you know, on fire I was meeting people. But like this one conference, Funnel Hacking Live, where I met a whole bunch of regular people that had started these like super profitable online businesses. I was like, oh, okay, then this is real, right? Like I had come from like the brick and mortar construction world, all of a sudden being in a room with like 3,000 people that were making 10 grand a month, all gross profit because their products are digital and all they're doing is out there making content, became very, very real for me. And I knew that that was possible for me, the same way that exposing myself to a community of investors from all walks of life that have done it every which way, from Drew Barnhill buying homes on credit cards to Zach Correa, who's like got best in show at an alpaca show and then leveraged that into his like real estate deal, you know, like every which way. And I'm probably misquoting you, Zach, but every which way possible, you know, and the 10 people that are like, dude, read Rich Dad Poor Dad. And like I had to hear that like 15 times before I read it. But the cognitive bias of seeing is believing and being exposed to something will immediately change your paradigm faster than any book, faster than watching Tony Robbins on TV, right? Because that's like that dude, like you said, the novice mind, right? That guy's so far beyond me that it's like hard to relate. But as soon as I meet somebody like you, that's real to me, that I talk to and I have this conversation, I'm like, bro, this really, really works. And a really skilled networker now has his own, like, wrote a book and now has a real estate fund, like now has his own funds and investing club because you did this the right way. That's very real to me, right? Like you have reset the expectations of what I think I can do myself with networking with your story, because we've gotten deep, right? Like, because we've been able to talk about it. So I agree with everything that you just said, man. Like the networking piece of being exposed to folks that can do it is the ultimate shortcut, both psychologically and, you know, physically, right? Like knowledge wise.
Awesome. You definitely have a fan club here. So Pablo, keep doing it. So I just open the door. Does anybody have any questions? I know from the chat, you guys seem like a bunch of experienced investors. Let's see if there's anything. Hey, John, go ahead.
John's always got questions, man. Yeah. Come on, John.
John, do you want me to just scroll up and see which questions you kind of asked that we didn't get to yet?
Let's see where he goes. Yeah, John is
So let's what would you recommend? Let's knock that out. What would you recommend to someone that is 21 years old and has 2 properties? So I'll let you answer, then I'll give a quick answer on that.
Why don't you answer that, man? I think you were that guy.
Well, 15 years ago, I was that guy. So what I would recommend is get involved earlier. I had this mentality, I think, until I hit over 30s, that I was too young for this or whatever it is. And, you know, I couldn't play with the big boys and all of that stuff. I feel like my 20s was wasted because of that. It got to the point where I finally, you know, believed in myself that, hey, I could really do this. I started partnering with people that I'm like, wow, these people are a lot smarter than me, and they're giving me their time and they think highly of me. This is, you know, I got to think better about myself. So I would say, it's not about what your next financial move is. It's about building that self-confidence in yourself, that the financial, you know, opportunities, that's going to come. You know, you're so young, you know, that's going to come, but really, really believing in yourself that you're capable, and then just start surrounding yourself with people that are doing what you are, who you want to be in 5, 10 years. Start surrounding them with them now. Even if you're just adding one person to your network, after 5 to 6 years, and those are the 5 to 6 people that you surround yourself with, you're going to be one of those people.
Heck yeah, man. And listen, I've been John was in my like Toastmasters like 3 years ago, and I've been, you know, mentoring him throughout. Haven't seen him in a while, right? Because I've been super busy, but like John is really trying to do that. And I echo everything that you're saying, right? Like the fact that he's 20 years old and he's already like really getting after it. Time in the game, man. You know, like I see relationships and real estate as compounding assets, right?
Yeah.
Like, you know, time in the game is really going to help, and be kind to yourself, John. You know, I know that John is in the space of like, I'm 21 and I'm not Grant Cardone yet. And you know, like, and that says something about me. I would be kind to yourself and listen, you know, to what Dennis is saying. Surround yourself with people, add value where you can. Don't underestimate the value that you have to offer. Like if you keep hanging around with people that have achieved what you want to achieve, be there as a curious person that can help in any way possible, instead of like questioning whether or not they're giving you the right advice, and just like take what works for you and keep adding to your skill set, and you're gonna be killing it, man, in no time.
Got it. Okay, let's do one more question, then I gotta close the call. How do you get lending on a low income to scale up to 10 to 30 properties? Is it okay? So the answer to that question is really about creativity. This is where something like where Andrew was mentioning, buying a credit card, doing it the right way. You definitely want to mentor with someone. You don't want to do that wing it by yourself the first round. But creativity, seller financing, subject to, you might want to go more into the wholesaling space because they are experts at creative financing. So stuff like that is really, really helpful when you're trying to get to 10 to 30 properties and your income is not going to cut it. The other big thing is partner with people that do have the high income, and you're basically their boots on the ground. You're the one that's finding the properties, and you just make it as easy as you can for them to basically, hey, I found this property. This is the, you know, projected returns. Do you want to put up the money for it? And then you kind of figure out that way. So I think that's the answer to the first part. Is it okay if I don't invest in the stock market and just invest in real estate? Absolutely. It is completely on your risk profile. I am a pro stock market guy, but I'm not going to tell someone who goes on emotional tilt when they see some red that they are a good fit for the stock market. So definitely find your own, you know, your playground of assets. Pablo, I'll let you add to that.
Bro, elbow grease, man. I've heard so many local guys here in Jacksonville being like, man, if I'd pay a 20-year-old to just knock on every door in every single neighborhood every single day. Go do it, John. Right? Like, just go do it. Put work in it.
And, you know, Marilyn said a good point. Read Rich Dad Poor Dad. Educate yourself, because in education, you're going to find, you know, the way to get to the next step. That being said, I want to wrap it up. Thank you guys so much for jumping in. I know a lot of your guys came in. I saw some of my guys here and there. I'll definitely send out the recording. I definitely want to clip this into a couple of different things because I thought this was great. Cool. So thank you guys so much. Pablo, we'll connect after the show. I'll send you a quick email to thank you. And thank you guys.
Dennis, man, I appreciate the opportunity to be here and, you know, like be guilty by association with your brilliant mind and share the stage, man. So you got my number, man. My love language is text. I suck at email. You've seen it. So text me whenever, bro. Even if you need help repurposing this video, man, I got a team, right? So let me know.
All right. I'm going to take you up on that offer. Thanks.
Let's go. All right, bro. Bye.
Take care, guys. Bye.